Hello and welcome to our new YouTube channel where we bring you the best and most informative content on finance and money management. Today's topic is about understanding the different types of borrowing. Borrowing is a common practice that many of us engage in to finance our operations, whether it be for personal, business, or government use. However, it is important to know the different types of borrowing available to make informed decisions about your finances. The first type of borrowing we will discuss is secured borrowing. This type of borrowing requires the borrower to pledge collateral to secure the loan. The collateral can be any valuable asset such as a house or car. Secured loans usually have lower interest rates because the lender has a lower risk of losing money. An example of secured borrowing is a mortgage where the house serves as collateral. The second type of borrowing is unsecured borrowing. Unlike secured loans, unsecured loans do not require collateral and are based on the borrower's creditworthiness. These loans have higher interest rates because they are riskier for the lender. An example of unsecured borrowing is a credit card. Revolving credit is another type of borrowing where the borrower can borrow and repay the money multiple times up to a certain limit. Credit cards are the most common form of revolving credit where the borrower can use the card to make purchases and repay the balance at the end of the month. Installment loans are a type of loan where the borrower repays the money in fixed monthly payments over a set period of time. Examples of installment loans include car loans and personal loans. Payday loans, on the other hand, are short-term loans that are usually due on the borrower's next payday. They often have very high interest rates and fees and are typically used by people who are unable to access other forms of credit. Student loans are used to pay for education expenses such as tuition, books, and room and board. They can be either federal or private and have different interest rates and repayment terms. Home equity loans allow homeowners to borrow money based on the equity they have built up in their homes. The interest rates are usually lower than other types of loans, and the money can be used for a variety of purposes such as home improvements or debt consolidation. Business loans, as the name suggests, are used to finance business operations such as purchasing equipment or hiring employees. They can be secured or unsecured and have different repayment terms. Lines of credit are a type of credit that allows the borrower to access funds up to a certain limit. The borrower can withdraw funds as needed and only pays interest on the amount borrowed. Bridge loans are used to bridge the gap between two transactions such as buying a new home before selling the current one. They are usually short-term and have high interest rates. Peer-to-peer loans are obtained from individuals rather than traditional financial institutions. They are often used by people with poor credit scores who are unable to obtain loans from banks. Microloans, on the other hand, are small loans that are typically used by entrepreneurs to start or expand their businesses. They are often offered by nonprofit organizations or government agencies. Cash advances are a type of short-term loan that is obtained by using a credit card at an ATM. Cash advances often have high interest rates and fees and should be avoided if possible. Securitization is a process where loans are bundled together and sold to investors as securities. The investors then receive payments from the borrower's repayments. Factoring is a process where a company sells its accounts receivable to a third party at a discount. The third party then collects the payments from the customers. Lease financing is a type of financing where the borrower leases an asset such as a car or equipment from the lender for a set period of time in exchange for regular payments. At the end of the lease term, the borrower usually has the option to purchase the asset or return it to the lender. Bridge financing, on the other hand, is a short-term loan used to bridge the gap between the need for funds and the availability of long-term financing. It is commonly used in real estate transactions where the borrower needs quick access to funds to purchase a property before securing a long-term mortgage. Lastly, we have trade credit, which is a type of borrowing where the borrower receives goods or services from a supplier but is not required to pay for them immediately. Instead, the borrower is given a set period of time, usually 30 to 90 days, to pay for the goods or services. It is important to understand that each type of borrowing has its advantages and disadvantages. Secured loans usually have lower interest rates but require collateral. Unsecured loans do not require collateral but have higher interest rates. Revolving credit allows for flexibility but can lead to overspending. Installment loans provide predictable payments but may have longer repayment periods. When considering borrowing, it is important to read the fine print and understand the terms and conditions of any loan before signing on the dotted line. It is also important to consider your ability to repay the loan and the impact it may have on your credit score. In conclusion, understanding the different types of borrowing is important for making informed decisions about your finances. Each type of borrowing has its own advantages and disadvantages, and it is important to choose the type of borrowing that best meets your needs. Remember to always read the fine print and understand the terms and conditions of any loan before signing on the dotted line. Thank you for watching, and we hope you found this video informative. Don't forget to subscribe to our channel for more informative content on finance and money management. As Warren Buffett once said, do not save what is left after spending, but spend what is left after saving. So let's all work towards saving wisely and spending responsibly.